I will now like to turn the conference over to Ms. Megan Colkert of Investor Relations for Novelis. Please go ahead, ma'am.
Thank you, Maria, and good morning or evening, everyone. Welcome to Novelis' second quarter fiscal year 2021 earnings conference call. Hosting our call today is Steve Fisher, our President and Chief Executive Officer, and Dev Ahuja, our Chief Financial Officer. Following the presentation, the call will be open to analysts and investors for questions. This conference call is being broadcast on the internet at novelis.com in the Investors section. A replay of this call will also be available on our website. Before I turn the call over to Steve, let me remind you that today's earnings release and presentation include forward-looking statements as defined in the Private Securities and Litigation Reform Act of 1995. These statements are subject to risks and uncertainties. These risks and uncertainties include, but are not limited, to those factors identified in the release and in our filings with the Securities and Exchange Commission. Today's presentation also includes certain non-GAAP measurements. Reconciliation of these measurements is provided in the financial statements included with our earnings release, as well as in the appendix of our presentation. Now let me turn the call over to Steve.
Thanks, Megan. And good morning or evening, everyone, and thanks for joining us today. I hope you and your families are safe and healthy as we all continue to manage through the challenges associated with the coronavirus pandemic. The health and safety of our employees has always been and will continue to be our top priority. I am so proud of our team and their dedication to supporting our customers. As a result of their focus, our expanded global presence, and good cost control across the business, we delivered both record shipments and record adjusted EBITDA in the second quarter. We have successfully executed rapid changes in our operations and production schedules, leveraging our global footprint and rising to meet the strong recovery in customer demand during the quarter. After a challenging first quarter resulting from temporary customer shutdowns due to the pandemic, we saw a significant sequential improvement in results. Shipments grew 19% in Q2 compared to Q1, while EBITDA increased a massive 80% on a sequential basis. Much of this improvement is attributed to the recovery in automotive, building and construction, and other specialty markets, and continued resilience in global beverage can markets. In addition, we continue to manage costs in a deliberate manner, focusing on the necessary costs to ramp up operations to meet customer orders. Given our strong liquidity levels in excess of $2.6 billion, we have the financial flexibility to act quickly as our key end markets recover and continue to prioritize strategic capital projects for long-term growth. All the while, we are hitting integration milestones related to the completion of the Analysts acquisition this past spring. Our global footprint and diverse product portfolio provides us with a considerable level of stability as there is some uncertainty related to the pandemic. And with the acquisition of Analysts, we further extend Novelis' leadership position in the aluminum industry. Turning to slide 4, let me provide you with the actions Novelis has taken in response to COVID-19 to protect our employees and maintain business continuity and the current needs of our customers as in-market demand for aluminum products broadly strengthens. With the advent of COVID and the health and safety of our employees our top priority, we have implemented a number of additional measures in line with guidance from global health authorities to help bolster our already rigorous EHS processes and protocols. This is helping ensure the well-being of our people, facilities, and communities. On the operational side, as many customers resumed production in May, we were able to safely and reliably ramp up our own production to meet increasing order levels. All our plants are operational, with nearly all running at near capacity levels. In addition, the commissioning processes at our newest automotive finishing lines in the U.S. and China, as well as our expansion in Brazil, continue to make great progress. We entered the fiscal year in a position of financial strength, actively managing costs and maintaining a strong liquidity position to respond to changing market conditions. We have also prioritized capital spend toward our strategic growth initiatives and sustaining CapEx to protect our operations today while still being able to grow for the future. We continue working closely with our customers to adjust production based on their sales forecasts, which took a decidedly positive turn in the second quarter. Beverage can continues to show its resiliency to economic cycles and benefiting from higher at-home consumption that favors package mix shift towards increased demand for sustainable aluminum cans. This is most pronounced in North and South America, with can makers in these regions reporting they are selling every single aluminum can they can produce. In South America, the shift towards off-premise consumption has driven the share of aluminum cans as a package type for beer to 61%, up nearly 10 percentage points in just 1 year. Customer demand remains generally resilient in Europe and Asia as well, but facing some challenges mainly related to reduced tourism. Meanwhile, the automotive market in the U.S. and Europe saw a very sharp recovery in our second quarter. After a several-week shutdown by major automakers in early spring due to COVID-19, IHS Markit has again upwardly revised its 2020 light vehicle sales forecast in October, reflecting improved demand and production conditions across all markets. And in China, the automotive market continues to see strong demand for SUVs, electric vehicles, and luxury models which favor aluminum usage. The 2020 to 2025 10% compounded annual growth rate for global automotive aluminum sheet demand remains unchanged despite the short-term COVID challenges. The near-term order book also remains very strong with our automotive finishing lines running at their upper limits. However, we note visibility beyond the next few months remains difficult to predict. Moving to specialties, customer demand has improved on a month-by-month basis since some temporary customer shutdowns in the spring, with many markets heading towards pre-pandemic levels. Building and construction, painted products, consumer electronics, and foil packaging are all performing well, with others such as heat exchangers and transportation gaining strength. Aerospace remained muted in the quarter and is expected to remain soft well into next year as OEMs reduce build rates due to lower consumer air travel. Turning to slide 5. In April, we completed the acquisition of Analysts and have been hard at work integrating their operations into our business. We completed the required divestment of Duffel for €310 million in September, and over this past weekend signed an agreement with American Industrial Partners, a private equity firm, to sell the Lewisport auto body sheet business for an estimated net cash proceeds of $171 million. While we are disappointed that the real value of the Lewisport asset is not fully represented in this agreement, hindered by the time-constrained situation in a very difficult market, with these divestments now behind us, we can turn our full focus on integration, value capture, and continuing operations. I'll provide an update on the integration efforts after Dev covers the results for the quarter. But first, I am really excited with the progress our teams have made with the construction and commissioning of our organic expansion projects. Both automotive finishing line projects in China and the U.S. are currently being commissioned. At Guthrie, we are already sending coils to customers for qualification and target commercial shipments by the end of this fiscal year. Changzhou is tracking as planned, just a couple of months behind Guthrie, with customer qualifications beginning this quarter and commercial shipments anticipated in early fiscal 2022. Meanwhile, our casting, rolling, and recycling expansion in Brazil to support our can business continues to progress. The project is moving full speed ahead with all equipment now on site and a targeted startup in early fiscal 22. I'd now like to turn the call over to Deb for a more detailed review of our excellent financial results.
Thank you, Steve, and good morning or good evening. Well, as a reminder, with the Analysts acquisition completed in April, the contribution of the Analysts assets from April 14 onward are reflected in our fiscal 2021 results from continuing operations. Results related to the Lewisport and Duffel plants are reflected as discontinued operations. We reported net loss of $37 million in the second quarter of fiscal 2021, including $181 million net loss from discontinued operations. On a continuing operations basis, net income of $144 million is 17% better than the prior year. Excluding tax-affected special items as outlined in the back of today's earnings press release, we reported net income from continuing operations of $158 million. This is just $2 million below the previous year, as higher after-tax adjusted EBITDA was offset by higher depreciation, amortization, and interest, mainly associated with the acquired Analysts business. Adjusted EBITDA increased 22% versus the prior year to a record high $455 million. This is primarily the result of higher total shipments and strong cost control across the business. Notably, EBITDA grew year over year even before the positive contribution from the acquired Analysts businesses. We will walk through the EBITDA bridge in a little more detail on the next slide. Consolidated company EBITDA per ton also reached a new high at $493 per ton in the second quarter. Net sales increased 4% versus the prior year to $3 billion. The increase is mainly due to higher total shipments, partially offset by slightly lower average LME aluminum prices and local market premiums. Total flat roll product shipments increased 11% versus the prior year to a record high 923 kilotons. The total flat roll product shipments recovered at an even faster pace than anticipated following first quarter lows impacted by COVID-related customer shutdowns. The increase over the prior year is mainly due to the 114 KT related to the acquired Analysts business, with the majority of this volume being strong North American continuous cast shipments. Automotive shipments recovered sharply from Q1, with shipments doubling on a sequential basis in Q2 and being up slightly year over year in the quarter. Beverage can continues to remain relatively resilient, with shipments down low single digits, primarily due to some softness in Asia and a difficult prior year comparison in Europe. Turning to slide 8 and the EBITDA bridge, simply speaking, the 22% improvement in EBITDA year over year is a reflection of good cost control and utilization despite the significant increase in volumes. Overall, the Q2 fiscal year 21 adjusted EBITDA of $455 includes $55 million net EBITDA contribution from the acquired Analysts business this year. The continuing operations from the acquired business are performing very well, with the BNC businesses surpassing our expectations. This is reflected across this bridge. Volume gains contributed $109 million to EBITDA, mainly a result of higher shipments. The unfavorable price and mix is mainly a result of lower can and automotive pricing year over year. And higher fixed and SG&A costs associated with the acquired business are mostly offset by strong cost control. As shared on our last earnings call, we are actively managing costs in line with customer demand. We have identified over $250 million of potential run rate cost reduction actions for fiscal 2021 if needed to help mitigate any temporary softness in sales. However, as we have been able to quickly respond to meet the rapid improvement in customer demand, we will gladly exchange operating cost reductions for higher sales while continuing to implement sustainable cost control measures in other areas like SG&A. In addition, we are off to a strong start identifying acquisition and integration cost synergies, with initial cost synergies reflected in year-to-date results. Now let's turn to free cash flow on slide 9. On a year-to-date basis, we have grown free cash flow significantly as compared to the prior year to $132 million. We are generating robust operational cash flow, improving working capital, and being prudent and strategic when it comes to capital expenditures. As Steve outlined earlier, we remain committed to our various strategic investments that are enabled by strong operating cash generation. Capital expenditures are down 27% year-to-date as we prioritize strategic and maintenance CapEx this year in a prudent move to preserve cash. We continue to anticipate full-year fiscal 2021 capital spending to be in the range of $450 to $500 million, including the addition of sustaining capital expenditures for the acquired Analysts business. We now expect to deliver very strong positive free cash flow for the full fiscal year 2021 at levels at or above what we delivered in fiscal 2020. With the improvement in EBITDA in the quarter, our net leverage ratio improved to 3.7 times at the end of Q2. We remain committed to reducing net leverage to get back to below 3x through total debt reduction and EBITDA expansion. We also continue to maintain ample liquidity levels, ending the quarter with $2.6 billion, allowing us to adapt quickly to potential changes in customer demand. I'd now like to turn the call back over to Steve.
Thanks, Dev. As you know, we completed the acquisition of Analysts in April and have been working in parallel since on integration and on completing the divestments of Duffel and Lewisport. And as I expressed earlier, we are disappointed in the Department of Justice's decision to require us to sell Lewisport to AIP. However, we have to move forward and focus on the path ahead. Novelis is already realizing benefits from the acquisition, in some cases more than we even expected, and is better positioned than ever for long-term sustainable growth. Turning to slide 11. As we spend more time integrating assets and building a better understanding of the operations, what has become abundantly clear is that the 4 key strategic pillars for the transaction remain firmly in place, and we are excited for the strategic and financial benefits this acquisition brings to Novelis. A key strategic pillar for the transaction was the diversification of our portfolio, including entry into the high-value-added aerospace end market. While current markets are soft, the long-term fundamentals remain strong. Aerospace is not a large portion of the business in terms of percentage of total shipments, but provides high value mix in core aerospace plate and sheet with favorable long-term customer contracts. We've gained well-established technological capabilities and see the potential for R&D synergies across other parts of our business, such as automotive, allowing us to further strengthen our product offering across value streams. Meanwhile, the acquired continuous cast business in North America has outperformed our expectations. The building and construction market is very strong and provides a level of long-term stability to our portfolio backed by favorable U.S. housing market fundamentals. This is a very cost-effective business with a streamlined product mix that utilizes in excess of 90% recycled content that directly supports our sustainability strategy and purpose to shape a sustainable world together. The second strategic goal was the ability to fully integrate our existing automotive business in China. As I spoke about earlier, the Chinese automotive market is performing very well in the near term, with strong demand trends driven by electrification and the need to improve vehicle performance by lightweighting. I'm excited to announce that the engineering study in Xinjiang for a cold mill investment, which we initially estimate would require an approximately $300 million capital investment, is now getting underway. Once completed, this will open access to underutilized hot mill capacity to feed our two cash lines in nearby Changzhou. Not only will this increase our cost competitiveness with a sustainable circular footprint in a 3 to 5 year time frame, it solidifies long-term business stability and proves to our customers we are making a commitment in the region. The third pillar is automotive diversification and growth, which will be achieved through our organic expansion. Our newest automotive facilities in Guthrie and Changzhou are already in the commissioning process and nearing readiness to support the needs of our customers. Lastly, as we roll up our sleeves and better understand how we can leverage the power of the combined company, our value capture work streams are discovering significantly higher combination synergy potential. We now estimate total synergies can exceed $180 million, far exceeding our original estimates. We estimate $65 million are transformational synergies achieved by integrating our China business. This is a result of creating efficiencies with scrap consumption and cost savings from the elimination of import duties and significantly reduced transportation costs. In addition, this releases capacity in our Korean rolling mills, providing flexibility and optionality to capture new market opportunities. The other $120 million plus are combination run rate cost synergies that can be achieved within 3 years. These are your traditional combination synergies in SG&A, IT, procurement, and supply chain as examples. Through the end of September, less than 6 months since closing the transaction, we have already achieved $38 million of run rate cost synergies, providing full confidence in meeting our increased target. In addition, we believe there are further opportunities to drive synergy savings not yet quantified through operational improvements. By leveraging Novelis' proven experience driving operational efficiencies and using digital technologies, we believe that there are opportunities to unlock additional capacity, improve recovery and uptime, as well as utilize some current open hot mill capacity while delivering high-quality products to satisfy our customers. These initiatives combined provide a clear and strong path to achieving nearly $370 million in EBITDA contribution from the acquired business within a 3 year time frame. Our starting point of $188 million reflects an annualized Q2FY21 Analysts EBITDA of $55 million, adjusting out some of the synergies already achieved. We add to that the $120 million of identified cost synergies and our base case assumption for market recovery post-COVID. We believe there is further growth as we reach full capacity and implement operational efficiencies. Additionally, this does not include the $65 million of transformational synergies after we complete our China investment. On a consolidated basis, Novelis is expanding its global presence with a diverse, innovative, and sustainable product portfolio. Assuming a pace ramp-up of automotive shipments in line with customer demand, this directional FY23 product mix does not yet capture our full potential in automotive. From a total capacity standpoint, we believe the pro forma capacity of the combined business can grow from about 3.9 million tons today to upwards of 4.5 million tons with some investment and optimization. In short, this transaction continues to prove its strong strategic rationale, financial profile, and significant cash flow generation, solidifying Novelis as the world's largest and most diverse aluminum FRP producer and recycler. In summary, we are fully focused on the smooth integration of Alaris to drive synergies, unlock value, and generate nearly $370 million in EBITDA in the next few years. Our record financial performance in the second quarter is a testament to our strong customer relationships across a diversified portfolio, ongoing operational excellence, and our expanded global presence with the addition of Alaris. This business model durability, diverse product mix, and global footprint put Novelis in a position to continue to successfully navigate COVID-related uncertainty while safely meeting our customers' rapidly changing needs. We are actively managing production, costs, capital spending, and liquidity levels with a focus on deleveraging to protect our employees, customers, and all our stakeholders for the long term. At the same time, we are completing strategic expansion projects to further extend our leadership position in the industry. With that, we're happy to take your questions.
Thank you. If you would like to register a question, please press the 1 followed by the 4 on your telephone. You will hear a 3-tone prompt to acknowledge your request. If your question has been answered and you would like to withdraw your registration, please press the 1 followed by the 3. As a reminder, please limit your questions to 1 and 1 follow-up question. The first question comes from the line of Carl Blunder from Goldman Sachs. Your line is now open.
Hi, good morning, all. Thanks for taking the time. It's Carl Blunder here at Goldman. Look, I think the organic results look really good. I just had a couple questions on the balance sheet and then on the divestments. When you think about the divestments now largely being agreed upon, we have some clarity. What does that mean in terms of your next steps for the balance sheet, terming out maturities, and then how much liquidity you'd like to run with? Just given that we still have some COVID volatility out there.
Right, Carl, thanks for the question. Good morning. So I think our plans ahead are very clear. With the divestments done, the proceeds from the divestitures have already partly gone, i.e. from the Duffel transaction, have partly gone to reduce debt. And as we realize the proceeds from Lewisport, it will again go to reducing our bridge. Now, as we look at the path forward to your question, the whole focus right now is to deleverage. You can see that we are generating very healthy cash flows this year as compared to last year. We have seen a very robust growth from 18 million to 132 million of cash flow. So what we are doing is just taking a pause, looking at the economic environment in the middle of all this uncertainty, continuing to focus on cash generation and just delever. To a specific point about sort of the debt and how we will deal with that, as far as the bridge finance is concerned, we do not intend to refi the entire $1,100 million. We do not intend to do that. We will do a stub portion of that, and we will deal with a large part of that by repaying through internal generations. We have other term loan maturities coming in 22, like the 1.733 billion outstanding term loan that's coming in fiscal year 23. And we will deal with that in the early part of next year or up to mid next year. So that is the one that we will refi. So in short, to summarize, basically we'll pay down the bridge largely from internal generations and maybe refi a stub portion through unsecured debt. And really that's really the big focus.
And Carl, as I said in my prepared remarks, we stand committed to deleveraging below 3x within the 2-year time frame.
Thanks, Stephen. That's helpful. Just one follow-up. With the acquisition, the timing, I guess, was challenging in some ways around what happened to the aero end market. But I'd be interested just in the last couple of months where you've been closer to your customers now owning the Alaris facilities and relationships. Does COVID do much in terms of the market share opportunities you have longer term here? Sometimes volatility creates more opportunity to engage and grow if you're not the largest in the space. I'd be interested in your thoughts on that dynamic.
Yeah, Carl, I would echo your views on just the overall timing with COVID impact, especially as it relates to the aero business, and the reduced build rates that those OEMs are going to have for some time into the future. And we'll have to take a look at that overall business and understand where those opportunities do exist. And we're quite pleased with what we've found in their customer relationships. And other opportunities, whether it be other commercial plate opportunities or even potential defense opportunities that are not significant in their portfolio, in the portfolio we acquired today. And then I would just also add on the VNC business, that is a business that we probably didn't understand the efficiency of that business and how it runs. And the overall market fundamentals that are behind that, and we believe will be intact for some time into the future. So again, very pleased with the overall continuous cast and BNC business that came in the U.S. as well.
Thanks for the thoughts.
The next question comes from the line of Matthew Fields with Bank of America. Your line is now open.
Hey, everyone. Just want to focus first on the divested Lewisport assets. I think that, the $170 million price, like you mentioned, Steve, is a little disappointing. I'm wondering, is that net of any liabilities assumed by the buyer? And then just can you kind of square us with how you kind of got to that answer? I mean, it was our understanding that this was kind of a $100 million EBITDA business, give or take. So understand that the DOJ kind of forced your hand, and that's never a great position to be in, but sort of a little color behind how you got to that final result, please.
Yeah, no problem. So let me just start with a clarification on the $170 million. We're trying to, as we're disappointed, we're just pulling the Band-Aid off. That is what we believe the net actual cash proceeds would be after all adjustments. So it's an estimate. It could change a little bit, but that is what we expect to receive in cash proceeds. The process, obviously, we ran into this right, getting the order from the arbitrator right as COVID-19 started. Couldn't found, a more difficult market condition to be in and selling an asset. We ran a robust process through that time frame, and we're disappointed the Department of Justice didn't give us some more time to sell this, because in a better market, you'd have gotten a more reflective price, similar to what we believe we got for Duffel when we sold that in November of last year, pre-COVID. I will also say, though, to what we did find at Lewisport is not what we expected. It's not as fully operationalized or commercialized as we would have expected it to be at this point in time, which also had some impact in the overall valuation associated with that asset.
And I'm sorry, just to clarify, that's not a net of any pension or OPEB liabilities, and it's the entire facility. It's not just the auto line. Just a little clarification there.
It's the entire facility, net of everything.
So I'm sorry, what are the liabilities associated with that you're divesting?
All liabilities are being divested. So this is a net number of dollar proceeds to us at the end of the day. We're not retaining any liabilities associated with it, and all assets go.
Okay, and I'm sorry if maybe we can follow up offline, but what are the liabilities on top, of the cash proceeds that you're netting against? So what's the total EV of the business?
So the EV is the EV, as stated in the purchase agreement, is roughly about $330 million, and we're netting off liabilities. The biggest one being working capital as well, in the adjustments there too. And so clearly, you can also see that to your comment earlier that the expectation of $100 million of EBITDA, the facility is not generating anywhere close to that $100 million at this point in time either.
Got it. Okay, thank you. And then, my other sort of area would be sort of on the can sheet market. We've seen an enormous amount of new capacity additions from Ball and Crown and Ardagh and now Canpack in North America. By our estimation, the North American can sheet market is going to have to grow by about 300,000 tons, give or take, over the next couple of years to satisfy all this capacity. How do you see that playing out with kind of organic debottlenecking from your facilities, maybe some brownfield expansions, maybe new competitors like Arconic has said they want to get back into the can sheet imports? Kind of how do you see the overall mix of growth and supply to satisfy that demand?
Yeah, so first of all, we're really excited about the growth that we're seeing in that market, driven by, I think, sustainability trends that we've been talking about, that our customers have been talking about as you think about, a beverage can being infinitely recyclable versus other materials. So huge opportunities. We've been working with our customers of kind of quantifying those opportunities, but you're absolutely right. We believe growth rate for can sheet through 2025, we're talking about something in the 3 to 5% in the North America marketplace, which is substantial. You see all the announcements of our customers and their lines that they're adding over the next several years that really puts investment dollars behind it. I think the market, is tight. I think it's even tight when you think about Arconic coming back into the marketplace. So I think we expect the market to remain tight over the next several years. We will do everything we can to debottleneck our facilities to gain more capacity from what we have today. When we think about it from a greenfield, just to put it out there, a greenfield investment is a difficult one because current can sheet prices in the North American marketplaces just wouldn't support that type of a greenfield. So right now, at least, until we see how things adjust over the next several years, we'll be much more focused on the debottlenecking investments to meet some of that increased capacity.
Great. That's really helpful. Thank you, and good luck.
Thank you. Increased demand, I should say.
And the next question comes from the line of Amit Dixit from Edelweiss. Your line is now open.
Yeah, hi. Thanks for taking my question and congratulations for a good set of numbers. Just wanted to ask on the beverage can market again, that some of your contracts, I understand, were due for renegotiation. So just wanted to get an idea of what proportion has been renegotiated and what would be the quantum of, if it is possible in terms of percentage, what would be the quantum of increase that you might have got now?
Yeah, so we're constantly negotiating contracts around the world. These are longer-term contracts, typically, somewhere in the 2 to 4 year type range, and they're rolling. So we're constantly in negotiations. So it's hard to place that specifically. I think from my previous comments, we feel very good about the global demand outside of North America. I said 3 to 5%. I think in our other three regions, we're seeing growth of around 4% for the next 5 years, all driven by these sustainability trends. So the demand side is very strong. Markets are relatively tight around the world, ex-China, which should over time provide opportunity for some level of price increases. And again, it depends on what part of the world we're in, so there's a lot of dynamics there. But generally, that's the trend you should be thinking of.
Okay, great. Thanks and all the best.
Thank you.
Our next question comes from the line of Pinakin Parekh from JP Morgan. Go ahead.
Yeah. Thank you. My question is on the broader Alaris acquisition. Now, if you look at the enterprise value of Duffel and Lewisport, out of the 310 million euros, if I remember correctly, around a third is under arbitration. And if we add the Lewisport enterprise value broadly, $560 million is the divested value. $2.8 billion was the acquisition value of Alaris, which means that at this point of time, 2.3 billion EV is for annualized EBITDA of just around $200 million. What does the management see the Alaris acquisition economics as it stands today far inferior compared to what it perceived it when the acquisition was first announced? Or does management think that eventually it will make up, but it will just take a lot longer than what it was earlier perceived to be?
Yeah, thanks, Pinikin. And absolutely no, we don't see it as significantly inferior at all. Yes, we're disappointed in the value we got for Lewisport. We will fight for the $100 million and believe we have the right arguments there. So we've recorded all 310 and believe we'll get the 310 million euros. But you know, as I said in the remarks, we have a pathway to 370 million when we see post-COVID market recovery. We stepped into it in the middle of some significant disruptions. It's going to take a little bit further on to get to the aerospace market. As I said before, B&C, we feel really good about that, and actually more value there than we were attributing to it originally. And then just the synergies that we're able to drive from this combination. And they're real synergies that are very tangible and understood. 38 million run rate coming out of the quarter already. We've upped that estimate from 150 with all assets to now 180. Without Lewisport and Duffel, 120 in traditional synergies that we have line of sight to get in the next 2.5 years. And in the transformational synergies, which really is a key component to the overall valuation of this transaction, is the China integration and the commitment to that marketplace that has tremendous growth in it. So not the same transaction we entered into, but we feel very good about what we've got and how we're integrating it into Novelis.
Thank you. For my second question, if we look at the profitability, it's near $500 per ton, record high. Now, the company has given a long-term directional capacity roadmap of 4.5 million tons. Against this capacity roadmap shipment mix, how should we look at the underlying profitability, directionally over the next couple of years? Is the second quarter a good benchmark, or is it inflated because of the pent-up benefits of volume coming through? How should we understand, margins from here?
Pinakin, let me take this question. So, to give you a direction for what is mid to long-term, more mid-term actually than long-term, you can think about somewhere between 480 to 500 as a sustainable EBITDA run rate per ton. And really, I want to clarify that, we were guiding earlier for standalone Novelis between 430 and 450. We are now, sort of going to be above that even for standalone Novelis. And for Alaris acquired business, it is an accretive business to the EBITDA per ton, a very healthily accretive business. So you can take about 480 to 500 as something that we will reach in a 2-year or so time frame. I mean, the only thing that we have to watch is how everything comes out of COVID. That's the only thing which is hard to guess. So far it's going very well, but that's the only hard thing to guess. So guidance 480 to 500.
Understood. This is very helpful. Thank you very much.
Thanks, Pinikin.
Our next question comes from the line of Sumanagal Nevatia from Kotak Securities. Your line is open.
Thanks for the opportunity. First question is with respect to medium-term growth revenues. Now, can we expect, since we have already had a tough time with Alaris acquisition with respect to regulators, and we've already the market leader in auto, can, and aerospace itself is a concentrated market. So can you expect medium-term growth to be largely organic, or is there any segments where we are still not there and we would like to evaluate inorganic growth, maybe something like an extrusion or something?
Yeah, very good question. I think I would say first, in the near term, next couple of years, we've got some great organic investments that are just commissioning the two auto lines that will drive growth in the auto sector. We've got the expansion at Pinda that is directed towards our beverage can position in Brazil and South America. And then we've also got the integration expansion, which will increase hot mill capacity that will come over the next couple of years. From there, we'll focus not just on rolled products and the expansion there, but on the sustainability efforts of the company around recycled content, more in-house ability to capture recycled content and process it in our facilities. That's what we hear from our customers. That is the trend from ability to provide low carbon aluminum to our customers. And then we also, as Dev and I have mentioned before, over the near term, I just want to reemphasize we are committed to the deleveraging, committed to getting below 3x, and so that is a commitment that we reaffirm today. With our strong cash flow generation, with our ability to generate cash, we will continue to look at other ways to grow. But as you highlight, auto, can, aero are all fairly organic type ways of growing. I think when we think about growth past that, we think of adjacencies to those businesses that could be up or downstream from there. But we don't have any other specific plans more than that.
I've got it. Next question is with respect to the total volume capacity of around 4.5 million tons. So it involves cold mill at China and debottlenecking of around 0.3. So what sort of timelines and investments should we expect for each 4.5 million tons?
Yeah, let me give you the pathway to 4.5 million tons. So the starting point is our traditional number of 3.4. We will have another 100 KT coming from the Pinda expansion, which will get commissioned 1 year from now, let's say, or a little earlier than that, let's say in the third quarter of next calendar. That takes us to 3.5. The legacy Aleris business is adding over about 500 KT. That takes us to 4. When we expand China, that takes us to another 200 KT, right? So that's 4.2. The balance 300 that you see is really optimization by driving efficiencies, and we have been doing that very well. This will also involve using some of the unused hot mill capacity that is available in the acquired Aleris assets. We have it in the continuous cast asset in North America, and we have in the Koblenz asset, the China asset, of course, we have it, and that's the China expansion. So essentially, the 300 will come from the other available potential hot mill capacity, which we can leverage over time. I will not put a specific time frame to that. That depends on the market demand. So out of the 4.5, we have very clear scheduled milestones to get to sort of 4.2, and the 300 will come over time with optimization and really what I just mentioned about the unused hot mill capacity. That's the pathway to 4.5.
Dave, what would be the capex involved for China 200 KT and timeline for that?
300 million. We will be kicking off the construction in the third quarter of next year, and you can take about 24 months from then.
Understood. And if I can just ask one more question that's more on the broad can market in North America. Now the shortage, there is no clear solution for that, and maybe in the interim there will only be imports. So, can we expect a step jump when contracts renegotiate in North America? And what is the mix we are currently sitting in terms of old contracts and revised contracts? Because the entire shortage is just a 2.5 year phenomena, and our contracts, I believe, is 4 to 5 years long. So are we still sitting on old contracts and see a big upside in the near term?
Yeah, we're sitting on a mix of contracts. I mean, as I said earlier, these contracts are somewhere in the 2 to 4 year range, and we continue to roll them. And we won't get into specific details past that right now. I just want to be clear on the shortage. The shortage is not canned sheet right now. Canned sheet is tight in the North American marketplace. The shortage is coming from cans themselves, the can makers, which are announcing significant investments. As those investments come online, you have some further open capacity, specifically Arconic, that's announced that they're coming back in from a canned sheet standpoint, and us and others continuing to debottleneck. So I don't think you should think of canned sheet being short in North America. It is tight, driving what we think are solid market dynamics over the next 5+ years, all behind the sustainability trend. So we don't. Also, you mentioned something of a short-term nature. We do think this is a sustainable trend driven by the sustainable package solution of aluminum.
Got it. Thanks for the elaborate answers, and all the best.
Thank you.
Our next question comes from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, good morning. Thanks for the opportunity. My first question is on your slide on path to Aleris EBITDA contribution. I want to understand on the $60 million, what are the assumptions behind it, particularly related to the aerospace business, the market recovery post-COVID $60 million. So are you assuming that at full capacity or partial ramp-up? How are you looking at that?
Yeah, So what we've assumed in the $60 million is basically getting back to levels in pre-COVID levels for aerospace. It's not taking full utilization of all the capacity of what Dev walked through. So as I said in my prepared remarks, we still think there's upside even to there from us driving operational synergies, utilization of further hot melt capacity around the world, as well as, just to be clear, that does not the pathway to 370 roughly does not include the transformational synergies that we'll get with the integration of our China facility. But it does, the $60 million, to be clear, brings it back to Aleris' pre-COVID level for those businesses.
Sure, and that's helpful. And second question, more on the financials. There are two exceptions in the discontinued business. One is $170 million, and the other is, I think, $11 million. Can you just give us some background? Is it the write-off regarding Duffel's sale, or how should we look at it?
Yeah, so the $11 million relates to normal operations. You know that until the time we own this asset, we have to take the net result, the net operating result post-tax into our books. So that is what you see in that $11 million, while the $170 million is more related to the pure divestiture impact, the impairment from the divestiture, loss from divestiture impact. So that's really how you should understand it. One is operations, the other is pure transaction.
Sure, understand. One last question for me. So what kind of timelines we should look at for the cash legalization from late port divestments? What are the approvals and what is the kind of timeline you're looking at?
Yeah. As the Department of Justice was the one that instructed the sale to AIP, approvals will move very quickly, and we expect to close this at the end of November. So the cash will come in November 30th, December 1st, this quarter.
Thanks. That's very helpful.
Thanks.
The next question comes from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yes, thanks for taking my question and congrats on a good set of numbers. Achieved $38 million of synergies in this quarter itself. Can you sort of briefly elaborate the areas where we have been, or you have been rather able to draw these synergies out of, and any region-wise breakup, if possible?
So I'll tell you what are the kind of areas that are contributing to the 38 million. A good part of the 38 million is basically from back office optimization. Essentially, as we are combining back office resources, whether it is finance, whether it is HR, IT, so we don't need to duplicate license fees. We don't need to duplicate the same overlapping organizations. These are some of the main areas that are contributing to synergies. You know that there was the senior management layer, when it was two companies, and as you get rid of the senior management layer, we just have one senior management combined in both the companies. These are the main drivers in the 38 million that you see so far in the synergies. As we go forward, we will be having other areas like purchasing. We have not even started that, and that's a big potential. We will add significant synergies from areas like purchasing and supply chain and the likes of that. But so far and for some time, a big part of that is going to come from really back office combination and driving efficiencies of the kind I mentioned earlier. And it's going better than expected. It's going faster than expected. It's going higher and better than expected.
Right. Thanks for this. And second is on the North American operations as a whole, the increase in spread that we see. How do you sort of explain it going forward? It is what we can understand is a mix of a very strong specialties market, given that a lot of capacities have gone out and you are one of the very few players left to sort of supply the market. Then there is a spread expansion in cans. And there are existing metal price, lead benefits also, and of course the scrap LME spread. So if you sort of bucketize these gains and look at a more sustainable picture, how much of your gains you would have sort of retained when you gave out this guidance of $80 to $500 per ton on overall?
So North America,
some thoughts.
Yeah, the North American business is one of the most sustainable businesses when it comes to driving future performance. You see that right now we are in this quarter we are at an EBITDA of like $559 per ton versus the whole of last year at $531 and the year before at $483. So really, what you have to really kind of understand here is that the auto market is doing very well, and this is sustainable because the preference towards SUVs, pickups, and the big cars is really helpful for us. So it's a sustainable market. Can market demand is a sustainable demand because a lot of habits are changing. New beverages are coming in cans. So even post-COVID, while COVID has some home consumption impact, but even post-COVID, the can market is going to do sustainably well. The BNC market has some cyclicality, but we see some very good tailwinds as we speak in the BNC market. Housing spending is good. New house builds are good, and that is driven by cheap finance, which is going to stay for 3 years, as the Fed has already said. Honestly, we do not see, and the duties, the recent additional countervailing duties are another factor that are going to help. You mentioned scrap. It's generally a long scrap market. Right now we are seeing a little bit of logistical issues, but overall it's a very healthy scrap market. And as imports of cans happen in the North American market, the scrap gets released into North America. It comes from elsewhere and it gets released into North America, which keeps the market generally long. So all in all, we are not able to see anything unsustainable in the North American business except for any ups and downs that may happen in the short term because of COVID.
Great, thanks. That's all from my side.
Our next question comes from the line of Anupam Gupta from IIFL Securities. Please go ahead.
Hi Dave, just one small clarification which I needed. So the impairment of $170 million which I have booked in this quarter, does that pertain only to Duffel or you just put all?
No, it's combined. It's the net result. It's the net result of both the divestitures. We will not get into details of the individual numbers, but it's the net impact.
Right. And just secondly, on the duffel disputed quantum, what is the dispute exactly about, and how confident are you of getting that back?
So the arbitration, we are very confident. We believe we followed the purchase agreement as signed by us and Liberty House back in November. It will take time to work through the arbitration. Our view is this could be up to a couple of years, but our view is that we are confident in collecting and winning the arbitration.
Okay. Understand. Thanks.
Our next question comes from the line of Kamlesh Jain from PL India. Please go ahead.
Hey, hi Steve. This is Kamlesh here. Just one question on the part of the, it may be sounding little hypothetical, but with the change in the regime, now the new regime would be more focused on the renewables or climate change and all those things. So how do you think this particular thing panning out in terms of our business going forward?
Yeah, it's early as it relates to a change of administration to know exactly. We've through our associations, we'll be actively working with the new administration to get better understanding of what some of their priorities might be. Generally, we don't see the drivers of our business aren't going to be impacted in the near or short term either under either administration. So I think all the demand outlook trends that we see and Deb just walked through in North America still we feel very comfortable with even under the new administration.
And lastly, on this ALRIS guidance of $368 million, so what is the timeline for that particular guidance to be achieved?
Yeah, so obviously you start with a run rate, which is already achieved. The synergies, 120, we've got 38. Dev highlighted that we're moving very well and quicker than we anticipated. With that said, we've always said to get to the 120s about a 2 to 3 year time frame. So, call that another 2.5 years to try and get that completed fully. And then on the $60 million, the best guidance we can give right now is a post-COVID recovery, because the assumption there is that we're getting back to the pre-COVID levels. And certainly we've seen some great traction on many of the businesses already. The one that is less certain of exact timing is the aerospace.
And Kamlesh, just to add one more thing, that if the post-COVID recovery is kind of floundering or takes a little bit of time, we are ready with cost action. So, it's not like that, we will have other offsetting actions if that 60 million block of market recovery does not have. A good part of that, we would try to compensate with cost. So just bear in mind that it's not like a 0 or 1. Either it's all the 60 comes with recovery or all of it is lost. No, it's kind of going to be halfway.
Okay, great. And lastly, on the Lewisport, I believe that a lot of questions have been asked on that front. But if you see these investments which were done by the ALRIS, like the $430 million alone on that finishing line, so against that we are getting $330 million. So really surprised the way, the way the regulatory have took the call. But what efforts have been put on that front to justify this particular valuation which we have got?
Yeah, no one could be more disappointed than we are in the ultimate outcome and what it really means for competition, because we don't think it's necessarily the right answer for competition to begin with. We've worked exhaustively over the last 6 months with the Department of Justice to come up with the best solution that we believed would satisfy many of the stakeholders, including competition, customers, and so forth. Unfortunately, under our agreement with the Department of Justice, when we agreed to arbitrate, The decision is at the sole discretion of the U.S. government, and at this point we have to accept that and move on.
Yes, thanks, sir.
Thanks.
Our next question comes from the line of Manav Madan from ICICI Bank. Your line is open.
Yeah, hi. I wanted to ask regarding the term debt. I think it is increased by about $1 billion from June. Any specific reasons for that? Why is it increased? Because is that a term loan or a sort of what are the maturities coming up for this term debt?
Well, so not sure from June. From June to now, we have actually reduced gross debt. But if you're talking about, sort of the 1.1 billion that we took, that is basically a bridge loan for replacing Alaris debt. And this bridge loan was taken at extremely, extremely favorable terms, and will be there with us until April 2022. We will repay a part of that from internal accruals. To your point about what's the plan, and some stuff part we may refi depending upon how we look at our internal cash generation. So net, no, it is not an addition of debt between June and now. It is really what we acquired at the time of the acquisition to replace the Alaris debt of up to 2 billion, you see.
No, my point is just that about 2 billion was the sort of a short-term borrowing which was appearing in June. Now that is gone and 1 billion is appearing in the long-term part. So that is just the 21 to 22 movement.
That is the maturity. Sorry, I'm sorry, I did not fully grasp the question earlier, but we have extended the maturity. Yeah. So earlier it was supposed to be maturing.
Yeah.
It was supposed to be maturing in... Okay.
Yeah, I'm aware of that. Yeah. My only question is, what is the outstanding on this bridge loan? Have we repaid anything from the proceeds that we have received in the second quarter?
So we will be repaid. We have repaid on as we speak now, but on September 30th you will not see that because that was just the time when we got the money. But in this quarter you will see the repayment from the proceeds that we get from divestitures.
Okay, got it. Thank you.